Joseph, according to Stanley Fischer, the Fed's vice chairman, the US may be seeing the first stirrings of a long-awaited increase in inflation as the impact of a strong jobs market works its way through the economy. What do you make of this?
He may be right. I suspect it won't be anything like the inflations of the past, the bad old days where we had 8, 9, 10% inflation. Right now, core inflation is running, depending on how you measure it, just slightly below or above 2. Around one measure says 1.7, one measure says 2.2.
Do you actually subscribe to the Phillips curve, the link between strong employment and inflation?
Yes, I think there's plenty of evidence for the Phillips curve. The problem is that there are other things that affect inflation that are not related to employment and that we really don't have a good handle on.
Moving forwards, do you anticipate the Fed holding rates steady, and why?
I think they will slowly raise them this year. I mean, there's a meeting and we'll see what they do. I suspect they will not raise rates this month, but maybe later this spring they will. I think they'll probably go slow because the world is so weak, and every time they raise rates, the dollar goes up. That hurts the U.S. economy and keeps it recovery at a slow. Now, the U.S. economy is doing okay, so I think it can stand a bit of this.
Well, as you said, March 15th, 16th, we'll hold a meeting of the Policy Setting Federal Open Market Committee. As you formerly worked at the Fed Reserve Board, what do you think is being discussed behind closed doors? What are we not aware of?
And they've got economists all over the country studying and talking to people and looking at the data at the finest level, so they really have a good sense of where we are in the U.S., and in particular on inflation. So I think they will be talking a lot about how solid is this job growth, how long will it continue, how certain are we that inflation is finally getting back up to target. That's what they'll be focusing on. I think the one thing that will be missing is any talk about whether they raise rates, if that will affect the dollar and therefore affect their forecast going forward. They generally have a policy of assuming that whatever they do has no effect on the dollar, but as we've seen lately, the dollar's been responding very much to what they do. And that is the question. Would they change that policy? I think they should.
Thanks for watching. For more videos from the Voice of the Market, please subscribe.